Hello, welcome to CDH's Cross Border channel. My name is Ko Fujimoto. Today, I want to compare US and the Japanese exit tax system. So by comparing these two exit tax systems would give you certain hints of the essence of cross-border taxation. So I want to really help your cross-border tax literacy and cross-border surviving skills. You don't have to know every single details of two countries' exit tax system, but I want you to kind of slowly build up your framework, in your brain, the framework of how to approach cross-border tax matters, so that even if the rules changes, may change in future, but you have a solid foundation to cope with a different tax rules. So that would be my purpose of this video. So let's see if I can succeed a little bit. Okay, so this is obviously an illustration. First, some people would move from US to Japan for certain reasons, retirement, medical reasons, and family reasons, and security reasons, and so forth. Okay, so if you move, it doesn't trigger US exit tax, but if you give up your US citizenship or US permanent residency, then it may trigger US exit tax. Okay. And then if you currently live in Japan, or we use the term demodori, coming back. So you decide to go to Japan to live. After several years, you decide that, okay, that's enough, I'm gonna go back. If you're gonna come back to the US, there may be Japanese exit tax. So the Japanese exit tax is different, obviously, from the US exit tax. If you move out from Japan, it would trigger this tax. So you see the difference. Now I just give you the difference in the first slide. The trigger points are different. US side is giving up US citizenship or green card, and Japanese side is moving out from Japan. So what's the purpose? What are the purposes of the exit tax? I want you to think by watching this video, and I want you to think why US and Japanese, there's two exit tax, the trigger points are different. Why is that? So let's see. I'm not going to give you an answer. I want you to think and form your opinion. Okay, let's talk about the US exit tax. I am a US CPA, so I'm a little bit, reasonably qualified to talk about the US side. All right, so who would be subject to US exit tax? And this is a very important point because not every persons who give up US citizenship or gives up US permanent residency will not face exit tax. Only a certain people would face a potential taxation. So who is that? It's called covered expatriates. So it's a technical term. Obviously, you don't really use this covered expatriate in your day-to-day conversation. I know, I understand. But this one, unfortunately, I want you to remember. Covered expatriate. Okay. Mr. Ko Fujimoto, I understand the covered expatriate term. Okay, tell me who they are. Okay, I will. Covered expatriate. Number one condition is you must be long-term resident, abbreviated as a LTR. Okay, now I am focusing, as you can see, now I am focusing on the discussion to a green card holder only. I'm not really talking about the citizen, US citizen side. So I am a little bit changing the scope of my video. I hope you understand. So now I am talking to green card holders now. So if you are green card holders and if you have held the green card 8 years or more in the last 15 years, then you are long-term resident. If you have a 1 day in a year as a green card holder, that counts as a 1 year. Okay? If you do not become LTR, you will never be a covered expatriate. I think this is crystal clear, right? Okay, I am a long-term resident. So does that mean that I will get taxed when I give up my green card? No. There is another condition. That is, there are 3 conditions. If you meet at least one out of 3 conditions, then you become a covered expatriate. So first, you must be a long-term resident as a green card holder, and then you must meet one of those 3 conditions. So even if you are a long-term resident, you don't meet any of the 3 conditions, you will never be a covered expatriate. Okay, so let's move on. What are the 3 conditions of covered expatriate? Another caution, I am repeating myself maybe, but even if you become a covered expatriate, it does not mean that you get taxed. Okay? I am not gonna explain how this taxation works in this video, but a lot of people basically freak out if, oh, I'm going to get taxed by the exit tax. No, not everyone. Not every covered expatriate, excuse me, not every covered expatriate get taxed in US exit tax. So let's set it aside. I just want to control your anxiety level first. Okay, so 3 conditions of covered expatriate. First one is, I call it $2 million test, and technical term is net worth test. If you have more than $2 million of worldwide asset, net asset, at the time when you give up your green card, or at the time when you give up your US citizenship, then you meet this condition, and then that means you become a covered expatriate, right? Number 2, 5 years. For the 5 years before you give up your green card, you must be able to declare that, yes, I have followed federal income tax rules, federal tax rules. It's a compliance test, okay, compliance test. In a form, I don't want to talk about too many form name, but in the last tax return you file, you must declare, yes, I have complied with the federal income taxation rules, 5-year period. Okay, the third condition is average federal income tax liability amount 2022. The average federal income tax liability $178,000 and more. It's a 5-year average, and you must be making a lot of money to be able to pay this much income tax to the IRS. Okay, this is not a state income tax, it's a federal income tax. Just to clarify, even if you don't have a $2 million in assets, but you fail, number 2, such as, okay, I failed to report foreign bank account in Japan, then yes, you are covered expatriate, even if you don't have $2 million. Okay, so that's how it works in this 3 conditions. If you meet one of them, well, let's maybe not meet, but I should probably say, I should probably use the word fail. If you fail one of these 3 tests, then you become a covered expatriates. So $2 million, when do you measure your asset? And it's a time when you give up your green card. That's the time, okay, the July 21st, I gave up my green card. On July 21st, or technically maybe July 20th, how much asset did I have is how you measure it, including real estate in Japan and whatever assets you hold anywhere in the world. Okay, and 5 years. Okay, when is the 5 years? So this is how you measure the 5 years. I give up my green card in 2022. So you go back to 2021 and 5 years. So 17, 18, 19, 20, 21, right? 2017 to 2021 is the 5-year period that you must be able to declare your compliance. Okay, I told you I'm not gonna talk about how the US government will tax you. That's a separate video. I want to change the gear to talk about the Japanese exit tax. I am not the Japanese CPA, so my knowledge and expertise is limited. I hope you understand that. Okay, so Japanese exit tax, I translate it to moving overseas tax. Moving overseas, then they will tax you. Okay, so please watch this. If someone who lives in Japan moves out, meaning, okay, I don't have any more address in Japan, or gift inheritance to non-resident of people who are not living in Japan, then this tax will apply. Okay, don't freak out yet, because there are different conditions. So, the condition number 1, you must own securities of equal to or more than 100 million yen. And if you live in Japan, you know the term oku. 1億円, 100 million yen. I hope I'm right in the math. But 1億円. 1億円. So the securities, if you hold the securities and I think similar items, and obviously I can't get into the details because I don't know, but you know what the security means, the stocks and the bonds and the mutual funds and so forth. Okay, so if you hold this 100 million yen securities or more worldwide, okay, not just in Japan, worldwide, then you have to start worrying. And you maintain your address in Japan more than 5 years in the last 10 years. If you meet these two criteria, then the tax will be levied on your unrealized gain of the securities. So before, okay, I move to the US, then when you move, then there will be taxes, okay? And also, if you give gifts or inheritance to the person in, let's say, in the US, it doesn't have to be in the US, but you give this, besides the gift tax or inheritance tax, you must supposedly must pay this exit tax, moving overseas tax. Enough, okay, enough, I understand. So I think this may apply to people like, okay, I'm going to move to Japan with my wife because she was born there and she feels comfortable, looks like it's safe, no one owns a gun, no one owns a gun. I think obviously police owns a gun, but maybe safer, and the medical conditions are better, things are cheaper, let's move. But after several years you decide finally, okay, I think I like to come back to the US. And when you decide to come back to the US, you would move out from Japan, and this tax may apply to you. So the purpose of this tax is to prevent Japanese resident, regardless of the nationalities, the Japanese residents sell or realize, and there's a typo here, I'm sorry, I will fix it later, but realize capital gains in no capital gain tax countries, such as Singapore, or maybe Hong Kong. I'm not the expert of the taxation of Singapore and Hong Kong, but by moving, and then so they would end up paying no taxes, no capital, because there's no capital gain tax in those countries. They end up paying no taxes, and Japanese government obviously don't like that, so they require you to pay capital gain taxes on those securities. Okay, so you see the difference between U.S. Exit tax and the Japanese exit tax. US is based on giving up US citizenship and US green card. Japan is based on the address. So once you understand the difference, and then once you start thinking, why is that? Why US decides that way and Japan decides that way? Let's start thinking. Let's start consider. Okay, but also, if you live in Japan or you are going to live in Japan, and you may qualify this. If you don't qualify, you don't have to worry. But right now it's 1 億円, 100 million yen. So if you think you own more than 100 million yen, then before you going out, moving out from Japan, you better be within the 5 years, right? has to be within 5 years so that you don't really maintain the address in Japan more than 5 years in the last 10 years. So you see the mechanics of this Japanese moving overseas taxes. When you own, if you in Japan, there's a address registry. I would say address registry. So you actually register yourself and then obtain, yes, I have a residence in Japan, and to a local government. That means you establish your address in Japan. It's different from you establish the status of resident. Okay, but I think this rule is based on the address, if you own the address or not. So this is my overview of Japanese exit tax. Obviously, I'm not the Japanese CPA. So if you want to know more, I'm happy to refer you to our partners in Tokyo, who can tell you a lot more about Japanese exit tax. But the purpose of this video is to really try to compare two systems just a little bit and to give you some framework of the two tax systems so that you'll be able to cope with them when you experience a cross-border lifestyle. Thank you very much for today's video, and this is my disclaimer and CDH Cross-Border Family Practice. If you have any questions, shoot me an email, crossborder@cdhcpa.com, and we will always looking for new team members to work with us. Remote is fine, part-time is fine, and we will teach you to become the true professionals of cross-border individual taxation. So thank you very much for watching my video and have a great day. Take care.